Hi everyone. Yeah, thank you so much for showing up. Sorry, have to change the Zoom link at the last minute. So I'm also a SubTo student. Happy to see all the fellow students. So a little bit background. I've been talking to so many self-directed RA firms, and Brian really stands out, very knowledgeable. So I just really want to save all of you some time to get the best wisdom. So Brian, yours now.
Great. Well, I don't know. I just turned on my video. I don't know if you can see that. Can people see my friendly face here as I'm warming us up? But yeah, thanks for having me, Angela. Glad to be here today. Our role here at Safeguard Advisors is to help people with self-directed retirement plans and the ability to take control of their tax shelter dollars and have more choices of investments. And I look forward to just giving you guys a little overview of what's possible, the types of things that can be done with these vehicles. They're very powerful as a way to do wealth building. And what we'll do is I have a little overview presentation. I'll stop once or twice along the way for questions. Just go ahead and use the chat feature. If you have a question, and you can send a question anytime, but there's a couple places where I'll stop. And then I'm definitely going to leave some time at the end of the presentation so that we could do a little more extensive Q&A about the topic then. So with that in mind, let's just go ahead and get started. So like I said, we're Safeguard Advisors and we do self-directed IRA plans. So a little bit about Safeguard. We're a professional provider of self-directed retirement plans, so a very niche space, small thing. The plan's been around for 25, 30 years, but it didn't really sort of become a specialty business until around 2004, 2005. And Safeguard was one of the first to recognize the power of the internet as a marketing vehicle and be able to reach a larger audience and be able to specialize in these types of programs. But there's something we've been obviously doing for a long time, working with investors all across the country who want to take more control of their retirement plan and invest in the types of things that they know and understand better. And a big part of what we do is not just setting up plans, but enabling our clients with education. It's really important in this space when you get outside the narrow box of the Wall Street exchanges. There's things you need to know, and we bring the necessary expertise in both real estate investing and also in the tax law and IRS rules to help our clients succeed with the plans that they set up. So what is a self-directed IRA? Well, it's a good question, and it's actually a broad term. You can have a self-directed IRA at Schwab, Fidelity, E-Trade, and it just means you pick the investment instead of having an investment manager. But it's sort of been a term that's adopted by our industry to really mean an IRA where you have more choices. But at the end of the day, it's still an IRA. We have both IRA and 401k solutions, and the back-end retirement piece is exactly the same. So contributions, distributions, timelines, all those tax-sheltered methods for retirement savings don't change, but it's just a different architecture so that the investment choices change instead of just being limited to the stock market and funds and things of that nature that we're all used to. And the types of things that, especially in a real estate focused crowd like we have here, real estate partnerships, rental properties, private mortgages, and trust deeds, any kind of private lending, those are very popular things that people choose to invest with. Why would you want a self-directed IRA? Always a good question too. And it's enabling a whole different thought about how to manage that retirement savings and to be able to invest in things that you may know and understand better. If you understand real estate, if you're a real estate agent, you understand the dynamics of how rental properties work and markets and how to manage tenants and things like that. You can probably have a lot more control over the outcomes than just shipping money off to Wall Street and hoping that you picked the right vehicles. It also gives you the ability to diversify. Diversify is always important. Diversification is always important. Any good financial advisor will tell you that, but then they'll have you pick a handful of different stocks in different markets that are all still stocks at the end of the day, right? So that's not true diversification. And when you start adding real estate and private placements and mortgages and things like that to the mix, you're now getting real true diversification. And then again, it's just really, it's all about control. It's being able to choose the investments you make, be able to have more impact on the outcome of those investments through your own, usage of the plan. And then at the end of the day, I mean, nobody's going to work as hard to grow your savings as you will. So the more control you have, the more ownership you have over the plan, the better outcomes that you can hopefully produce. Not everybody qualifies to take advantage of a self-directed IRA, and there's just a couple of basic things to know to see if these types of plans will make sense. Typically, you're not setting up a self-directed IRA and making an IRA contribution and funding it with $6,000 or $7,000 and buying real estate, right? So, you start with you got to have enough money to achieve the kinds of goals that you're looking for, and then that money needs to be available. And generally, the only funds that aren't available or if you have a 401k or similar plan with your current employer and you're under the age of 59, that money's probably locked up in that plan and you wouldn't be able to move it. But if you're still working for somebody over age 59 and a half, you'll have the flexibility to move money tax-free to a different plan. If you have an IRA, you'll always have control over that and the ability to move, or a 401k or similar type plan, a 457 or 403 or something like that from a previous job would be something you can move. And you can move, from a couple different accounts if they're compatible with each other. You can move all or a portion of account. This is not an all or nothing thing, but the bottom line about qualifying to take advantage of a self-directed IRA is having some funds that are accessible and having enough to achieve the goals. You can't mix IRA money and personal money to do deals. So you either have to have enough money in the IRA or be able to maybe joint venture with another investor on a deal or things like that. The types of plans that we focus on here at Safeguard provide what we call checkbook control. And that's different from an alternative in the marketplace where you're basically hiring a processor. And when it comes to investing in real estate, having the checkbook in your hand is it's necessary. Things are too time sensitive. There's just too many things that need to be taken up immediately. And you can't really wait 3 to 5 days for an institutional processor to receive paperwork and get it through their queue and sign off on documents and issue funds. You need to be able to take care of things immediately in the real estate space. I'll talk a little about the architecture of how we create that checkbook control in a minute, but it really eliminates a lot of paperwork and processing delays and per transaction fees that would happen if you just hired an IRA custodian to act as your processing layer. But it's still the way we create these structures all keeps everything very much under the umbrella of a tax sheltered IRA or 401k plan. There's two ways we create that checkbook control. We have an IRA-based solution that pretty much anybody can take advantage of. It's very flexible. You can invest in anything the IRS rules allow for, which really means you can't invest in life insurance or collectibles. Those are the only things that are off limits. You can roll over from a variety of different plan types into an IRA. You can choose to have a regular tax deferred or what's called traditional IRA. You can have a Roth IRA. You can work with an inherited IRA that you might have. Typically, it's going to be one IRA. So owner and tax type are the level of granularity when we talk about IRAs. But a really nice tool for taking some existing savings and having more choices over how you invest with it. The other program we offer is a checkbook solo 401k, and that's a more robust retirement plan. As an investment vehicle, it's mostly the same as the IRA in terms of the flexibility and the checkbook control and the rules around what you can and can't invest in. But for people who are self-employed and have an owner-only business with no non-owner employees who need to be provided benefits, the solo 401k is a great investment platform, but it also has high contribution limits. So you can put more money into your plan and reduce your tax burden and build your savings from the front end. It can house both tax deferred and Roth accounts in the same plan where they'd have to be separate in an IRA. There's a personal loan feature, what's called the participant loan on 401k style plans that IRAs don't have. So some people in the real estate space will borrow a few dollars out of their plan to fuel some separate personal deal that they're doing, and that can work. And then there's one difference on the investment side, which is if you're using mortgages, there's some advantages in the 401k as compared to an IRA, and I'll talk about that a little later. So going into a little more detail, the way the checkbook IRA works is it's this two-layered structure. There's an IRA that's held by a specialty institution, a company called Solera National Bank out of Denver. I like to describe them as E-Trade or Schwab with different paperwork, right? Because as I said earlier, the IRA side of what they're doing, no different than any other IRA you're familiar with: timelines, contributions, beneficiaries, et cetera. What's different is they have different processing. They can document the IRA's ownership of what we're going to do, as opposed to just being limited to transacting on the public exchanges. So one of a handful of specialty custodians that serve this niche that we really like their services. But we'll set up that IRA with Solera and then have it make a single investment into a specially created legal entity. And we'll use either an LLC or a trust, dependent on an individual's needs. Where they live, what kind of investments they want to be making, risk profiles, things like that. I'm not going to get into all the details today. If you want to learn about these programs, we can have a conversation, but just specifically tailored to what somebody's going to use. But the concept is the same either way, which is that the IRA owns that legal entity. I'm just going to, for the bulk of our conversation today, say LLC. It's a little more common format. So the IRA owns the LLC. You can act as the manager and have control and use that LLC as your transacting layer. So it's the LLC that's buying a property or doing whatever. All the expenses are paid from the LLC checking account that'll be part of this. And then all the income flows back into that LLC. And that's how we eliminate the custodial processing layer. We push the custodian back to the back end. The custodian is just documenting the one investment the IRA has made into the LLC itself. And then you use the LLC under your control to go do the actual investment transactions that you want to conduct. So that's how we provide what we call checkbook control, because you'll have signing authority on the checking account. And of course, signing authority for the entity itself to execute a contract or things like that. And a way to think of it, it's kind of like your IRA's own private fund, and you get to be the fund manager. And this fund, so to speak, can invest in anything that the IRS rules allow for. So that's the basic structure on the IRA, the checkbook IRA. The other program that provides the checkbook control is the checkbook solo 401k. And a little different architecture, and again, a little different qualification, but at the end of the day, it's kind of the same thing. The main difference is that as an employer-sponsored, 401k style retirement plan instead of an individual account, there has to be a business that's setting up the plan as an employee benefit, and it needs to be an owner-only business. The solo 401k is a very simplified version of the 401k that is designed for not providing benefits for non-owner employees. Once you have those employees, the administrative requirements are quite complex, and it wouldn't work very well in this space. But when you're only managing your own money in this simplified format, it makes it very easy to self-direct. So basically, you can be a sole proprietor, you can have a corporation or an LLC. It doesn't really matter what the business format is, but you have to be doing something that creates earned self-employment income, or a corporation where you're paying yourself a W-2 wage out of your own business. You have to have compensation income, not investment earnings. And again, you can't have any other employees in that business or any other business that you control. But if you do have that sort of owner-only business, then your business can set up the 401k, and it's a nice tool. It's a little more direct route to your ability to control the fund. So the plan, the 401k itself, is a form of trust. It's a retirement savings trust established under Section 401 of the tax code. And you as the business owner can act as the trustee. So now you have full control over the plan, and that's direct. We don't have to step through that third-party custodian and have that separate record keeper. You can just be the record keeper. And then very high contribution limits on the 401k. The current maximum here in 2022 is 67,000 if you're somebody over the age of 50. If you're under age 50, it's 61,000. Of course, you got to have sufficient income in your business to be able to do that, and the only income, it's only income from that business that can be used to make contributions. So you might not be able to get that high, but that's the top end of what's possible. As I mentioned in the previous slide, you can have both traditional tax deferred funds and Roth funds in the same plan, and take advantage of some more aggressive tax-free Roth strategies. You can convert internally within the plan, and it's very nice for people who are looking to shift in a Roth direction. And then, as I've sort of indicated a couple of times, and again, I'm going to punt this a little farther down the road, but there's a tax that applies on leveraged investments in an IRA, and the 401k is exempted from that type of taxation. So that's kind of the plans that come together. I might open up if anybody wanted to take a quick break there use the chat if there's a quick question or two. If not, we can go ahead and keep moving, and like I said, have questions at the end. But if you had a quick question on any of the structural piece and wanted to jump in, this would be a good chance to do that. Okay, well, guess we don't have anything going on. Let's go ahead and move forward. Glad that people are following along. So one of the things you got to keep in mind when you're working with these self-directed retirement plans is that this is still a tax-sheltered retirement plan. The whole point here is to help you save for retirement, and when your investments aren't taxed along the way, you get to take the money that you're not paying in taxes and reinvest that and mushroom the size of the savings over time. And this self-directed IRA works exactly the same way as an IRA in the stock market in terms of those features. Well, those tax sheltered benefits that you're going to have do come with some restrictions, which is basically that it's the plan that's the investor, not you. You're not saying, hey, I want to go do X deal. Here's some tax-free savings that I can get my hands on to fund my deal. It's, hey, I've got this great tax sheltered money. I'd prefer not to have all of it in the stock market. I'd rather take more control, but it's the plan that's the investor, and everything is being done exclusively through the vehicle of the plan and exclusively for the benefit of the plan. That means just everything needs to be done at arm's length, through the plan, separate from your own personal finances, things like that. And we have to avoid in all ways what are called disqualified persons. And those disqualified persons are yourself, your spouse, if you're married, lineal family like parents, grandparents, children, grandchildren, the spouse of a descendant, or an entity like a business or trust, where one or more of those people might have control. There's a few other financial entanglements, a business partner or a fiduciary, like a financial advisor who's helping you with your retirement plans. They can certainly help you with your retirement plan, but you shouldn't separately be lending them money from the retirement plan or things like that. But mostly it's avoiding the lineal family. So you can't buy a vacation home. You can't buy a property for your kid to live in while they're at college, or you can't use your plan to buy a home that you already own and turn it into a rental or things like that. It's just all very separate and under the plan. And we in our training like to just sort of tell people it's about mindset. Again, it's not, hey, I want to go do X, here's some money. It's, I want to go better manage my retirement plan. And we like to say, think of yourself as a fund manager, investing plan capital for the benefit of your future self, not your today self. Your benefit today is that you're going to have more money in your golden years. So let's move on from there and talk about some of the more popular things that people like to do with these plans. One thing that works really well is private lending, through trust deeds and mortgages. Your plan, whether it's an IRA or 401k, basically gets to be the bank. And we all know that banks make a lot of money. Well, you can elbow into their game, and there's certain areas that they don't like to play in. So if you know people who are real estate investors, maybe they're out flipping houses or doing new construction, or maybe they need earnest money, short-term money to go secure deals and come up with funding from other investors and things like that, what we call transactional lending. There's a lot of ways that your plan can lend money and collect interest. And depending on the type of loan you're doing, you can have a secure asset. It's backed by that real property, a mortgage note. You're going to go record that note with the county and have an enforceable security. Notes typically have consistent income in the form of, a prearranged interest payment. You can do short-term loans. You can do longer-term loans. It's just a great way to take some of that money and maybe, know exactly what you're investing in and have more control. You basically get to be your own underwriter if you're going to do this type of stuff. And it's suitable for smaller amounts of capital. You're not going to necessarily buy a property with, 50, 60, $70,000, but you can certainly lend to somebody who's doing a rehab flip and, provide construction capital or acquisition capital and get a good return for your money in that type of arrangement. So that's one of the popular things that people look at. The other, probably the single most popular thing that people look at with these plans is rental property. And again, it's a secure asset. You can create income in a lot of ways, not only, as we say here on the slide, with both cash flow and appreciation, but you can, if you're savvy, buy properties at a discount, add a little value through some selective remodeling. There's a lot of ways you can control the outcome of the performance of a rental property, and your IRA being able to participate in that investment and hold that rental property can be a really nice way to protect and grow your retirement savings. And again, the way it works is that checkbook layer, that IRA LLC or 401k trust is on title to the property. The IRA is going to, we'll just say IRA here, the IRA is going to buy the property. All expenses and all income, whether it's for the acquisition or maintenance or rents or the future sale, just all the flow of money goes in and out through that vehicle. It stays under the umbrella of the plan by staying enclosed in that envelope. You can, in a limited sense, property manage. You can do things like, post an ad and sign a lease and collect the rents and call in a handy person to do a repair, things like that. You're acting through the plan. The plan's hiring that person, not you. The plan's paying for those services. But you just have to avoid disqualified person. You couldn't hire your son, for example, to go paint your IRA-owned rental property, because that'd be a disqualified person transaction. And then when we talk about those limitations between the plan and disqualified persons, that also works in the other direction. Not only can you not benefit from the plan, you also can't inject value above and beyond those administrative activities. So you couldn't go and paint and clean between tenants. You'd be gifting that time and energy, that service of value, and basically making an undocumented contribution to the IRA in doing so, and that would be a rules violation. So, you just, again, think of yourself more as an asset manager in the asset of real estate than a property owner. The plan is the property owner. And then we'll talk about it a little bit. You can use mortgages. You can joint venture with other investors. There's lots of ways you can create deals. As in simple terms, as long as you're not intersecting with those disqualified persons, you have the flexibility to do deals like other real estate investors do deals, as long as you're working within the rules. One of the nice things about real estate as an investment class is it opens up the potential to use leverage, and leverage is just a really, really powerful tool for making the most out of an investment. You get to extend the reach of your capital. You get to use other people's money in addition to the plan capital. So maybe you got $100,000. Well, instead of buying a $100,000 condo all cash, you can go buy a nice, $200,000 single family home that's going to rent for more money and be a better, have better chance of appreciation and things like that. So you can bring the power of leverage into your IRA, something that you wouldn't do in the stock market. It's just too risky. But with the real estate, it can make a lot of sense. There's a couple special things to know when using financing inside of an IRA. Firstly, that the plan itself, the mortgage has to be non-recourse, meaning there's no personal guarantee from you as a disqualified person. You can't pledge your assets as security for the plan's debt. It's the property that's qualifying for the loan. There's a handful of lenders that do that. You won't find a non-recourse loan for an IRA rental property from Wells Fargo or Bank of America or any place like that, but there's some specialty lenders that do that. And because it's the property that's qualifying, you will see some more conservative lending, more commercial terms, typically 30 to 40% down, 10 to 15% cash on hand and reserves of the loan amount. That varies from, the risk factors, location, age of property, the neighborhood quality, things like that. The lenders are going to, take a little bit more loan to value on a nice, clean, rent ready property in a nice suburb than, maybe an older property, in a little less desirable neighborhood. But the lenders will be able to tell you what they can do. And it's a good thing to educate yourself on in advance if you're going to pursue those types of strategies. And then the other thing to know is that there are some tax implications when an IRA borrows money. I'll talk about that here in just a moment. But the bottom line, when you look at using leverage, is that it produces a higher cash on cash return for every dollar. And you want to keep your focus on that piece of how powerful this tool is. So let's spend a minute and go into that tax concept. A lot of people say, well, what do you mean there's taxes inside of an IRA? I thought it was a tax sheltered vehicle, and it is. But the situation here is unique. And what we're doing when we use mortgage financing on a rental property is the IRA is placing, say, 40% of the cash into a deal to make a down payment, but the other 60% is non-IRA money. It's the money that the IRA has borrowed. And so when you look at it, the percent of the income that comes from the down payment, the IRA's portion of the deal, well, that's 100% tax sheltered back to the IRA. And the IRA is going to receive all the income. But the portion of the income that it's receiving from the borrowed money is what's viewed as taxable. It's referred to as unrelated debt financed income, or UDFI. And something that applies not only to IRAs, but to all kinds of tax exempts and nonprofits. And it's just where you have this nonprofit entity using outside capital, the percentage of the income derived from the outside capital is taxable. But it's really not that big a deal, as hopefully this screen will kind of help you figure out, because everything's done fractionally. And with real estate, you have so many great deductions that you really offset a lot of the tax, and the tax itself ends up being pretty small. So here's a little example I put together. We got a property where it's $150,000 rental, $55,000 down, and a $95,000 mortgage on a non-recourse loan, and $1,750 a month in rents is what we can expect, which would turn out into $21,000 of gross annual rents. Well, everything when it comes to UDFI is done fractional. If we take this example, it's 64% debt financed. So that means 64% of that gross rental income, which is the 13,000 number you see there, is the taxable portion, right? So right up the top, $6,600 or $7,600 just isn't taxable. 13,400 is. And then of that taxable portion, you take your same ratio of your normally allowable deductions. So you've got your depreciation, your interest, your property taxes, your other allowable expenses that would normally offset rental income all apply, but they apply in the ratio. And we did a mock-up, sort of figured a 30% expense ratio or something like that, I think, when we did this. So you got just under $11,000 of deductions that'll apply against your income. And then there's also just $1,000 exemption off the top with UDFI. So in this little event we put together, example we put together, you have $1,600 of net taxable income out of that $21,000 that you created with the property. And when you run that through the trust tax tables that apply to the IRA, your tax due ends up being $240. So, you probably made an extra, $2,000, $2,500 in income by the fact that you were using leverage after paying your note and whatnot. And you give up a small percentage of that to taxation. And even if you factor in, a couple $100 to have a CPA do the return, you're still coming out well ahead. So the bottom line is that the leverage boosts your return. The tax on UDFI puts a small dent in that boost, but you're still going to see very much a boosted higher cash on cash return. The bigger concern is it's a little more complex strategy. You'll have to have a tax return for your IRA, which if you were doing an all cash deal, you wouldn't have to do. Another very popular thing to invest in our real estate crowd is real estate syndications, or multifamily, larger commercial deals of various types. And that's a great way to invest. And commercial real estate is a stable, high performing asset class. It's very much in demand in this economy. And basically with your IRA, you could take, your $100,000 and go be 1% of a $10 million property. And you can own, 1% of 100 doors instead of 100% of one door. And there's a lot of benefits to doing that kind of investing. You can leverage the expertise of a professional team that's used to operating at that scale and finding deals and managing all those doors. And it's really, really well suited to IRAs because obviously it's going to be arm's length. You're basically, in a way, buying a private fund and letting somebody manage that asset is kind of what it looks like. Your only concerns in terms of the disqualified person rules with the syndication is that the general partner is not one of those disqualified persons like your dad or your daughter or somebody like that. And then, real estate syndications do commonly use leverage. So you will have those same UDFI considerations, but you'll also have the same, higher leverage rate of return that you can expect from these types of deals. So they're, again, a real popular form of investing. And I wanted to, take a minute and look at how UDFI plays out in a syndication. And a similar concept. You put your $100,000 example into a multifamily syndication. Maybe it's 70%, 75% debt financed, a plan to, maybe buy something, fix it up, hold it for a bunch of years, and then eventually sell it. And they're predicting maybe a 10% average return on rents, which would basically be $10,000 of cash back to your IRA or 401k each year. You run that through all the tax calculations, take advantage of the depreciation and the deductions and whatnot, you're going to end up with about a $300 tax bill at the end of the year on that $10,000 that was returned in earnings. So you could see that's a very, very small impact that comes from the use of leverage in those deals. So it's a very, very, very big net positive. And then lastly, one of the other real popular things that people who are up to their elbows in real estate look at and is a high profit area is property flipping or new home development. Those can be done in an IRA, but there's a kind of cautious approach that you need to take around these types of investments. But as an investment, they're very appealing. And, it's a little more high risk reward. You really got to execute everything well to make money. But you have the opportunity to buy a property at a discount because it's in, just a neighborhood that's a little long in the tooth and needing upgrades, or the property itself just, needs a refresh. You can add value and control some of the profit outcome with the appropriate upgrades. And as a result, you can generate some really pretty good returns if you're good at these types of transactions. There's two challenges from the IRA perspective to flipping. Firstly is the requirement to operate at arm's length. You're an asset manager. You're a fund manager deploying capital. You're not a real estate contractor. You're not a developer on behalf of your IRA. So you pretty much have to have a team in place. And you can oversee a team, but you can't be operating under your own licensing. You can't be swinging hammers and working on a property. You shouldn't even be, running to the hardware store once a day and getting the materials for the subcontractors that are working. You can't provide those services to the IRA, but you can make decisions. You can execute contracts. You can pay for the operation. That's fine. So oftentimes you'll typically find you want to have a partner, either an investment partner or a contractor who's really, maybe not financially, but partnering with you to do the deal and get it executed. It definitely takes a team to do this type of investing. And then the other consideration is that all the things we've been talking about thus far are passive forms of income, interest, rental income, things like dividends and royalties, which don't really come up in real estate. Those are passive forms of income that are going to be sheltered into an IRA. When we talk about flipping or spec home development, now we're actually talking about engaging in a business. You're a real estate developer. When you're flipping houses, it's a dealer activity in many cases. And if you're doing that in the outside world, with regular dollars, not planned dollars, that's often at any volume threshold going to be looked at as earned income. It's not capital gains. Well, when an IRA or 401k engages in a trade or business on a regular basis, it's deemed to be in competition with tax-paying businesses, and that subjects it to taxation. And that taxation is on what's considered to be unrelated business taxable income, or oftentimes referred to as UBIT, which is the name of the tax paid. But it's a tax that's designed to level the playing field and protect those tax-paying businesses from unfair competition. I'm actually getting a little bit ahead of myself. So again, passive forms of income, rental income, interest, dividends, whatnot, not going to have that UBIT concern. But if you're going to engage in a trade or business on a regular basis, you need to be aware that this UBTI is being generated, and your IRA can have a tax liability. And unlike the tax that applies on leveraged income, where you get so many different tax write-offs that mitigate the taxes, you're not going to see that as much here. You're just going to have your expenses and your income, and the net between the two is pretty much going to be taxable income. And it pretty quickly ratchets up to the maximum trust tax rates of 37%. That happens at $12,700 or something like that, if I remember correctly. So that can be a pretty big hit, and it can be a disincentive to doing this type of investing in an IRA. But let's take a look. It might not always be a deal killer if you have a good opportunity, or there's also some ways to work around the strategy. But here's an example of what I would call, kind of a juicy flip here, but it's nice, simple, easy numbers to get the concept across. So say you bought a property at auction for $50,000. You put $19,000 of rehab and holding cost in. You had a little cost to sell, so your total costs at the end of the day end up being $25,000, and you were able to turn around and sell that for $100,000. So you've got a $25,000 operating income, net income from that transaction. Well, that $25,000, when you run it through the trust tax tables, is going to produce what's not an insignificant tax bill, $7,600. And you look at that and you go, ouch. But I'm going to tell you, skip that. Pretend you just bought a luxury refrigerator set and you just had more cost to do your deals. What matters is not how much it costs you to get there. What matters is how much money did you make at the end of the day. And in this example, that's still $17,000 on a what was essentially a $69,000 investment that you probably turned around in 4 to 8 months. So if you can find deals like that, yeah, it might not be the most tax efficient way to do a flip, but what else are you doing with your IRA that's generating 25% return on investment? So something like that could make sense in that kind of scenario. There's also, by the way, I saw that question. I will come to that in a minute. Thank you, Kyle. There's 3 approaches you can look at with flipping, and sometimes shifting your approach can be the smarter way to go. You can flip with your IRA, pay the UBIT, and be happy. As the example that we just saw. You can choose to take a passive approach and be the bank, like we talked about in the first investment slide on being a private lender. You can make it much more arm's length and easy. You can make it passive income by having your IRA be a lender to somebody who's not a disqualified person, but some other investor who's flipping houses. You can maybe be their hard money lender, collect 2-3 points on the front end. 12 to 15% interest is pretty common on these kinds of short-term, higher risk loans. That's a real nice return on investment, and it's passive. You don't have to do a tax return. You're turning over your money every 3, 6, 9 months, whatever the types of deals you're in can turn. So that's a good way to make an investment. Then there's the last strategy, something we've kind of come up with a nice term for. We call it a hybrid flip. And when people think of flipping, it's buy a property, fix it or not. Maybe you're fixing bad finances, not a bad kitchen, but buy it, fix it, turn around and sell it and profit. Well, if you just do that, if you do buy, fix, sell, that's a dealer activity. That's a business, and that's going to create UBIT. But if you use that same front-end acquisition strategy to buy something that needs some repairs, so you can maybe get it at a discount, maybe add some value through that effort, well, that's great. If you immediately go to capture that value, it's a flip. But if you stick a tenant in there and have that tenant pay rent for at least a year, now that's a passive rental house. And when you go to sell in the future, whether it's 13 months down the road or 5 years down the road, whatever, doesn't so much matter. Now you can capture that value you built on the front end with the discounted buy and the rehab and get that profit without any tax hit whatsoever. You've now just, you're getting what would be a capital gain in the after-tax world, and something that would be fully sheltered into the IRA. So those are a couple of different ways to look at that. And then I wanted to go back. Kyle had jumped in with a question about how often you would have to flip to be considered a business. And I wish I had a static answer for that. The language we get from the IRS is when a tax exempt engages in a trade or business on a regular or repeated basis, it's deemed to be subject to UBIT. And what regular or repeated means in any particular case is determined by the facts and circumstances and whatever that IRS auditor that stumbles onto your case decides they want to call regular or repeated. So it's pretty vague. What it really comes down to is you look at those facts and circumstances, and what the IRS is looking at is somebody trying to shift their taxable business into the tax exempt realm, or is a truly tax exempt entity coming and substantively competing with tax-paying businesses doing a similar type of thing. So the threshold's different with flipping houses than it might be with selling cars or furniture or something like that. There's a variable. What we'll tell people is there's no black and white line, and your approach needs to be either, conservative, and I'm going to back off on these types of activities and make sure that if I do something, it's occasional and infrequent enough that I just don't need to worry about it, that I don't care. Or you can be a little bit more aggressive and know, well, I'm going to make a judgment based on some information I have that I haven't crossed that line, that I'm not subject to UBIT, but you're going to understand that the IRS could pull your number up and decide to audit and come and look and disagree if you get a little more aggressive. Our take, talking with several tax attorneys that we work with, we're pretty heavily networked and obviously been doing this for a long time, and you will not get one answer, trust me. But the sort of the consensus is, if you're doing one flip maybe every 18 to 24 months, and you're balancing that out with some other non-flip activities, things like some hard money lending or holding some rentals or whatnot, that's going to look not like the focus of what's being done, and that's not going to have a risk of triggering UBIT. But then there's other factors, like if you're personally flipping 10 houses a year, even doing a one a year inside your IRA now looks like you're trying to take your personal business and put some of it in a tax exempt envelope. That'd be a whole lot different if you're, a software engineer or an educator or something like that, and your IRA is just doing that one flip and you're not doing any personally. If you're buying a house and rehabbing it with the intention to rent it, you put a for rent sign up, 2/3 of the way through your rehab, and somebody walks up and says, I love this neighborhood. I've been looking for a house here forever. I love what you've done with this house. Can I buy it? Absolutely. Just don't go do the same thing again, 2 months later. So there's some room to do some level of flipping. And it's just sort of the threshold is going to depend on some other factors and how aggressive you want to be. And keep in mind, if the IRS were to audit you and determine that you had UBIT and didn't pay it, it doesn't disqualify the IRA. It's not like a prohibited transaction that's catastrophic. It just means what you thought was a non-taxable transaction became taxable, and the taxes are a little higher than they would have been if you paid them up front, because you're going to have some penalties and interest and things like that. So it's certainly not anything you would want, but it's not, deadly catastrophic. And then one other thing I realized I skipped over and I forgot to mention before we wrap up these things. When we're talking about unrelated debt financed income on the rental property and the syndication, that applies to IRAs. That's where the 401k has the advantage. The 401k is exempt from tax on UDFI when the debt has to do with the acquisition of real estate specifically. So if you have that qualification for a 401k and you want to do mortgage, rental properties, or you want to invest in syndications, it's going to be a lot simpler and a little bit more profitable than it would be in an IRA. Still great in an IRA. It's even better in the 401k. So that's kind of the presentation part of what I had for you. I want to switch over and do questions. I see another question that Chandra had asked about how quickly can you get the money out to provide an earnest money deposit or do a private lending transaction. Once things are built, which typically takes between 3 to 4 weeks end to end to get the program set up and get money moved from a previous retirement plan. Once it's in your checking account, you can wire funds on a moment's notice. You have full control. There's no delay in the system. It's just whatever, the banking limitations might be. So you can be very responsive. Did we have any other questions that people wanted to bring in? A shy group today, huh?
I think John is asking, can you
Yeah, no, I
lend?
did just see another question come in. So great. So yeah, so John asked a question about, can you lend out contributions and earnings? And yeah, the answer is yes. I mean, like any other IRA, you're going to have what you've contributed to the plan, maybe what you roll over. You can continue to contribute to a self-directed IRA if you're eligible. If you have another 401k, you might not be eligible, but if you're able to contribute to any IRA, you can certainly contribute to this one. So that's putting new money into the plan on the front end. But say you roll over $100,000, you use this for 2-3 years, you don't make any new contributions, but you've grown it to 120. That comes back off of deal A, and you got $120,000 sitting in the plan. That's all available to be invested in the next deal. So yeah, there's no real split between those two different flavors of money in the plan. And again, with respect to contributions, distributions, beneficiary inheritance, all those concepts, this IRA is not any different than an IRA in the stock market. It just has different investments in it. We had a question, if I have an IRA, currently, do I have to transfer the entire amount? And no, the answer to that's no. Again, if you have, say, an IRA at Vanguard, it's got, $300,000-$400,000 in it, and you want to take 100 of that to go do some private lending, you can absolutely do that. You can just move that portion that you want to have access to. You could move more in the future. So say you started off and said, well, I don't want $100,000 to do this syndication, and then that syndication matures, and you say, you know what, if I grab another 100, I could go buy a rental property, and I'd rather do that. That's fine. It's very easy to move more money in the future. You have a wire fee involved. It's just not a big deal to do. It takes a little time. And the reverse is true as well. You might say, hey, I did a couple of investments in my self-directed IRA. I'm in between deals. I got a little money that I don't have a non-traditional home for right now. I'm going to send it back to my brokerage IRA and put it back in the stock market. Unfortunately, it's a little tricky to do stock market investing inside these specialized plans, but you can definitely have multiple plans. You can move back and forth between them. There's a formal process you have to go through and do it the right way, but it's very flexible, and we help people do that all the time. So Angela had a question. If you had one IRA where some is tax advantage and some is tax deferred, so are you talking about a non-deductible portion of an IRA there? Because with an IRA, it's either tax deferred or it's Roth, and they would go in totally separate accounts. But you can, in a traditional IRA, have a portion of that money that's deemed non-deductible. Maybe you had a 401k and you were over the income limit to make a deductible IRA contribution, but you decided to contribute anyway, which you can. But that basis that you added gets special tax treatment called non-deductible. I mean, you can have that, and it's just something you need to track over time, and not so much how it grows and changes. That's all going to be tax deferred, but just whatever the basis was that was in that non-deductible status is something you just need to know. And your tax returns will tell you, I made a $6,000 non-deductible contribution in 2022. I did another one in 2025. So my total non-deductible amount, whether it's in 25, 27, 30, is still just that $12,000 that you initially put in. It doesn't change over time. I don't know if that answered the question, Angela.
Who should I keep track of?
Usually you're going to need to, you're going to need to do that, or your CPA. You'll have it in your records from your account statements. That different money will be tracked and reported differently, but no third parties really tracking that for you over time. You kind of need to know, and the impact is in the future if you want to do a Roth conversion, or if you want to start taking distributions, you need to know what percentage of the account has that, because that's not going to be taxed at the time that you do those other events.
When I set up the self-directed IRA account, how do I differentiate these two, or do not?
I'm sorry, I didn't quite catch that.
But if I set up the self-directed IRA account, but some is tax deferred, sometimes it's not, then how do I?
Well, you just have to know, you have to know when you start what amount is what. And if you make new contributions in the future, you just basically, any time you have a non-deductible portion, you just need to know what it is. But it's only that one time when you put it in. It doesn't change over time unless you put more in the future. So it's pretty easy to track.
Okay.
So I had a question here from John. So he said, at the beginning of the conversation, I mentioned you can't mix IRA money and personal money, and asked if I could elaborate that. Well, we got to the idea that you're a disqualified person to your IRA, and as a disqualified person, you can't benefit from or provide benefit to or commingle funds or pledge a guarantee. I mean, you basically just have to keep a very extreme firewall between yourself and your personal finances and your IRA. And that just has to do with everything, whether it's a down payment, you couldn't buy a property in your IRA and find that you need a repair, and if you don't have enough money in your IRA to do that repair, you're in trouble, because you can't pull out your personal checkbook and do that repair. Your IRA would basically have to go find a lender or a partner to bring into that deal. But you just always have to keep a complete separation on that. And we got another question. What amount do people commonly need to have these programs worth it? And it varies. I mean, we don't typically have a hard minimum on our side, but we'll always talk to somebody and see if what they want to do is going to make sense. I would say sort of a practical minimum in the real estate realm is in the 50 to 60,000 range. That's going to allow you to do private lending. If you're an accredited investor, but just have that small amount of IRA money that's accessible to you, you could do private funds or syndications or things like that. But again, because you can't, commingle IRA and personal funds, you're not going to take, 20,000 of IRA money and 100,000 out of your personal pocket to go, put 120 into a deal. So you just got to look at it and say, do I have enough to accomplish what's being done with a little bit of, buffer for contingencies? And then secondarily, is the juice worth the squeeze, right? You're going to be setting up this program, it's some work, there's some expense. Can you generate enough better return that it's better than just leaving it in an index fund? Because even if you make, 3-4% better, if that's only on $15,000 or $20,000, have you really moved the needle? No, you really haven't. So kind of see 50, 60 as the bottom end. The average account size is probably only, 150 to 125, something in that range. I mean, we have people with $2 million in a Roth IRA, good for them, right? But that's rare. Most people are working with, $100,000 to $200,000 and taking good advantage of these programs. Kyle asked if you can take a personal loan from the 401k, and the answer is yes. I touched on that very briefly, but we can elaborate. So all 401ks, if the feature has been enabled, can provide what's called a participant loan. And with that participant loan, you can borrow the lesser of $50,000 or 50% of the account balance from the plan. So if you had, $80,000 in your plan, you can borrow 40. If you had 100,000 or more, the maximum you can borrow is 50. And you can borrow that money for up to 5 years. The plan is going to be lending to you. Once you borrow that money, you can use it for anything. We're not subject to the disqualified person rules or whatever. That's now money in your pocket that you're going to go do what you want to do with. Of course, the plan doesn't get any benefit from that investment either. And your obligation there is that you have to repay that loan on the specified terms. Otherwise, it's viewed as a taxable distribution. And like I said, the loan can be for 5 years. It's going to be set at prime +2. So that currently puts you at, oh crumb, they just changed it again on me, but I think it's 6.25 or 7.25. I forget, I have to look it up. But it's in that range. And you have to make payments at least quarterly. You can make them monthly, you can make them quarterly, but you have to make regularly amortized payments on at least a quarterly basis. You can't get into, fancy interest only and balloon or thing like that. You got to make those regular payments. So, and the issue is, you got to look at the opportunity cost for the plan. It's going to get that 7% interest. Well, that's not bad, but it's not great either. You could go do some private lending and create 12 or 15% interest, and wouldn't that be better for the plan? And then you're also, you put that money in tax deferred, perhaps. You're going to take it out and use it for some purpose. You're then going to be putting after tax money in to replace that money that was originally tax deferred. So there can be, some consideration around whether it's the right thing to do. If it's going to enable you to go ramp up your personal investing, maybe you want to go flip houses, which you don't want to do in your plan, you want to do personally, and you need some capital to get that going. The loan can be, a little startup capital to get your own business going, and that can be worth the minor downsides on the plan side. Things like that. Wouldn't use it to buy a car or pay for a kid's wedding or something like that. That's not a good use of a 401k loan. All right. Well, did we have any other questions from our group here?
I just want to add, so I'm going to post a recording of this link on our SubTo Facebook group, and then feel free to share the link to your friends so they can also listen to the information.
Yeah, you'll have that, and then I'll have a PDF version that I'll get to Angela's hands as well. Well, good. Thank you, everybody, for joining us today. Again, thank you very much, Angela, for inviting us on board. I'm always happy to share this kind of information with people. It's new to a lot of people, and it's fun to get to expose people to it. And hope you all have a fantastic weekend. Very good. Well, I'm going to go ahead and wrap it up. Thank you, everybody.